The stock market, a whirlwind of numbers, charts, and flashing screens. It can seem intimidating, a realm reserved for Wall Street suits and financial wizards. But beneath the surface lies a world of opportunity. Imagine transforming your savings into a nest egg. This is the allure of the stock market. But this world is not without its perils. Fortunes can vanish, leaving investors bewildered. It's a battleground where knowledge is power.
Many view the stock market as a giant game of roulette, where blind luck determines winners and losers. This couldn't be further from the truth. Successful stock picking is a skill, honed through dedication, research, and a deep understanding of market dynamics. Just like any craft, it requires patience, discipline, and a willingness to learn from both triumphs and setbacks. Think of it like a professional poker player studying their opponents, analyzing their tells, and calculating probabilities. They don't rely on luck, they rely on skill and strategy. Similarly, successful investors don't chase every hot stock tip. They research companies, analyze their financials, and understand their competitive landscape. This essay will equip you with the tools and knowledge to navigate this complex world.
We'll also explore the world of technical analysis, where charts and indicators reveal hidden patterns and market sentiment. You'll learn to spot trends, identify potential reversals, and time your entries and exits with greater precision. But mastering the art of stock picking goes beyond numbers and charts. It delves into the psychology of the market. We'll examine the emotional pitfalls that often trip up investors, leading to irrational decisions and missed opportunities. This is your journey to stock market mastery, a journey that begins with a single step, a commitment to learning and a thirst for knowledge.
Imagine you're buying a used car. You wouldn't just look at the shiny paint and kick the tires, would you? You'd pop the hood, check the engine, and scrutinize the car's history. Fundamental analysis is the equivalent of this meticulous inspection, but for stocks. It's about looking beyond the stock price and understanding the intrinsic value of a company. At its core, fundamental analysis involves dissecting a company's financial statements. These statements, the balance sheet, income statement, and cash flow statement, are a company's financial report card. They reveal a company's assets and liabilities, its revenues and expenses, and the cash flow generated from its operations. But numbers alone don't tell the whole story.
Financial statements can seem like a foreign language, filled with jargon and complex metrics. But fear not. With a little effort, anyone can learn to decipher this language of business. Start with the balance sheet, a snapshot of a company's assets, liabilities, and shareholder equity. Assets are what a company owns, liabilities are what it owes, and shareholder equity represents the residual claim on the company's assets after all debts are paid. Next, delve into the income statement, which summarizes a company's revenues and expenses over a specific period. It reveals whether a company is profitable and by how much. Pay close attention to key metrics like gross profit margin, operating profit margin, and net profit margin, as these ratios provide insights into a company's profitability and efficiency.
While numbers provide a solid foundation, fundamental analysis extends beyond crunching numbers. It's also about understanding the qualitative factors that can make or break a company's success. One crucial aspect is analyzing the company's management team. Are they experienced, ethical, and aligned with shareholder interests? A strong management team can navigate challenges, seize opportunities, and drive long-term growth. Another key consideration is the company's competitive landscape. Does the company operate in a highly competitive industry with low barriers to entry, or does it enjoy a dominant market position with a wide moat? Furthermore, consider the company's industry and its overall growth potential.
No discussion of fundamental analysis would be complete without mentioning Warren Buffett, arguably the most successful investor of all time. Buffett's investment philosophy centers around identifying undervalued companies with strong fundamentals, solid management teams, and durable competitive advantages. He famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Buffett's investment approach highlights the importance of patience and discipline in stock picking. He's a long-term investor who's willing to hold on to his investments for years, even decades, as long as the underlying fundamentals remain strong. He avoids chasing short-term gains and focuses on finding companies with sustainable competitive advantages that can generate consistent profits over the long haul. By studying Buffett's investment philosophy and analyzing his investment decisions, investors can gain invaluable insights into the power of fundamental analysis.
While fundamental analysis focuses on a company's intrinsic value, technical analysis delves into the world of charts, patterns, and indicators to decipher market sentiment and predict future price movements. Think of it as reading the language of the market, understanding the ebb and flow of supply and demand that drives price fluctuations. Technical analysts believe that history repeats itself in the market. They study past price patterns and trading volume to identify trends and anticipate future market behavior. They use a variety of tools and techniques, including chart patterns, technical indicators, and candlestick analysis, to gain an edge in the market. One of the fundamental principles of technical analysis is that price discounts everything. Therefore, by analyzing price movements, they aim to understand the collective wisdom of the market and identify profitable trading opportunities.
Chart patterns are formations that appear on stock charts, representing recurring market psychology and providing clues about potential future price movements. These patterns can be either bullish, suggesting a potential upward trend, or bearish, indicating a potential downward trend. One common bullish chart pattern is the head and shoulders bottom, which resembles a person bending over with their head between their shoulders. This pattern often signals a reversal of a downtrend and the beginning of an uptrend. Another bullish pattern is the cup and handle, characterized by a U-shaped price formation, followed by a slight downward drift, resembling a cup with a handle. On the bearish side, the head and shoulders top pattern, an inverted version of the head and shoulders bottom, suggests a potential reversal of an uptrend and the beginning of a downtrend.
Technical indicators are mathematical calculations based on a stock's price and trading volume, providing insights into market momentum, trend strength, and potential overbought or oversold conditions. These indicators can help traders confirm chart patterns, identify potential trend reversals, and time their entries and exits. One widely used momentum indicator is the Moving Average Convergence Divergence, MACD, which shows the relationship between two moving averages of a stock's price. A bullish MACD crossover, where the shorter-term moving average crosses above the longer-term moving average, suggests increasing upward momentum. Another popular indicator is the Relative Strength Index, RSI, which measures the magnitude of recent price changes to evaluate overbought or oversold conditions.
Combining technical and fundamental analysis offers valuable insights into the market. Fundamental analysis identifies undervalued companies, while technical analysis helps time entries and exits. Use technical analysis to find favorable entry points for fundamentally sound companies. Combining these approaches can maximize profits and minimize risks. Remember, no single approach guarantees success.
Technical analysis and fundamental analysis are crucial for stock market success, but they're only part of the equation. The missing piece? Your mind. The stock market is a psychological battlefield where fear and greed collide, often leading investors astray. Mastering the art of stock picking requires not only understanding numbers and charts, but also mastering your own psychology. Imagine this: you buy a stock based on solid research. The price dips slightly, fear grips you. You sell, locking in a small loss. Days later, the stock soars, exceeding your initial target. Sound familiar? This is emotional investing at play, a dangerous game that often leads to poor decisions. Fear can paralyze, causing missed opportunities. Greed can blind, leading to reckless bets. Successful investors understand the psychological traps that plague the market. They develop strategies to mitigate emotional decision-making. They stick to their plans, even when the market gets turbulent.
Emotions are powerful forces. They can lead to impulsive actions, especially in the face of financial risk. Fear, greed, hope, despair, these emotions can cloud judgment, leading to irrational trading decisions. Recognizing these emotions within yourself is the first step to mitigating their impact. Fear often manifests as selling during market dips, even when the underlying fundamentals remain strong. This panic selling can lead to missed opportunities as investors lock in losses at the worst possible time. On the flip side, greed can drive investors to chase hot stocks or invest in speculative bubbles, ignoring warning signs and risking significant capital. Hope, while seemingly positive, can also be detrimental.
The stock market is like a giant school of fish, constantly shifting direction. This herd mentality can be both a blessing and a curse. Understanding how to identify and interpret market sentiment is crucial for making informed trading decisions. When investors are bullish, prices tend to rise, creating a self-fulfilling prophecy as more buyers jump on board. Conversely, when fear and pessimism prevail, prices fall, often creating a downward spiral as investors rush to sell. This herd mentality can create opportunities for savvy investors to profit by going against the grain. Contrarian investing, the art of buying when others are selling and selling when others are buying, requires a deep understanding of market psychology and a strong stomach for volatility.
So how do you master the mental game of trading? It starts with discipline and a set of rules. First, have a clear investment plan. Define your goals, risk tolerance, and investment horizon. This plan will be your roadmap, guiding you through turbulent times. Second, diversify your portfolio. Don't put all your eggs in one basket. Diversifying across different asset classes, sectors, and geographies can help mitigate losses and reduce the impact of emotional decision-making. Third, learn to control your emotions. Recognize fear and greed when they arise. Take a step back, breathe, and reassess the situation rationally. Don't let emotions dictate your trading decisions. Finally, never stop learning. The market is constantly evolving.
We've journeyed through the intricate world of stock market picking, exploring the tools and techniques that can transform you from a novice investor into a seasoned pro. We've delved into the depths of fundamental analysis, learning how to dissect financial statements, decipher the language of business, and unearth a company's true worth. We've navigated the exciting realm of technical analysis, using charts, patterns, and indicators to read the market's whispers and anticipate its next move. But most importantly, we've embarked on a journey of self-discovery, exploring the often overlooked psychological aspects of trading. We've confronted the emotional pitfalls that can sabotage even the most promising investors, learning how to tame our fears, temper our greed, and make rational decisions amidst market chaos. This journey, however, is far from over. The tools and techniques we've explored are not mere formulas for overnight riches, but rather a foundation upon which to build your investment philosophy.
The allure of the stock market lies not in its potential for quick riches, but in its power to transform your financial future through informed, disciplined investing. It's about taking control of your wealth, growing it steadily over time, and achieving financial freedom on your own terms. Every successful investor, from Warren Buffett to everyday individuals who've achieved financial security, started with a single step, a commitment to learning, a thirst for knowledge, and a willingness to master the art of stock picking. They understood that knowledge is power, that informed decisions trump blind speculation, and that patience and discipline are the ultimate weapons in the investor's arsenal. Remember, investing is not a get-rich-quick scheme, but a journey of continuous learning and growth. Embrace the challenges, learn from your mistakes, and never stop seeking knowledge. The rewards, both financial and personal, are well worth the effort.
As we conclude this exploration into the fascinating world of stock market picking, remember this: you are not alone on this journey. Thousands of individuals worldwide are on the same quest for financial wisdom, seeking to unlock the secrets of the market and secure their financial futures. Join the conversation. Share your thoughts, insights, and experiences in the comments below. Let's learn from each other, support one another, and navigate the exciting world of investing together. And if you found this deep dive into the art of stock market picking valuable, don't forget to like, subscribe, and share this video with your network. Together, let's empower ourselves and others to make informed investment decisions and achieve lasting financial success.